A financial advisor for pro NBA players recently told me the strategy he uses for multi-million-dollar portfolios, and you won't believe how simple it is. And the best part is it works for small accounts as well, which means that this one simple strategy can grow your portfolio and make easy monthly income no matter what size your portfolio is. Let me show you how this works. I'm going to be using Apple as my first example of many in this free course on covered calls and creating $8,000 a month in income. All right, so first of all, Apple right here, I'm up $302,000. I have a big size position on Apple. This is my favorite stock for safe, passive, consistent income. And I'm going to first show you this example. I'm going to use different expiration days and go over every single thing that I look for in opening a covered call position. First, I'm going to just give you a quick example. Then I'm going to explain to you step by step in 5 easy steps why I'm doing this and my whole thought process. And then I'm going to show you the example one more time and go over many different examples. Okay, so real quick, I would go to trade Apple options. If I have 100 shares, right, I'll teach you about all that in just a second and picking the perfect strike price and buying the shares at the perfect time. This is a real quick example and I'll explain to you. If I go to sell call option and I go to, let's say I'm going to sell the 230, which I already have a decent amount of covered calls sold here. If I pick an expiration for November 15, go out 5 to 6 weeks. It doesn't matter when you're watching this video. This same thought process can be applied anytime in the future. If I were to sell this right here, and if I just sell 5 contracts, I can essentially collect $3,600. Okay. If I can sell 10 contracts, I would collect about $7,200 in 44 days. This, along with several other positions in your portfolio, can easily produce $8,000 per month in income. All right. Now let me explain to you every single step, the very easiest steps with all the details on why I would do this, how I would open up a covered call, etc. And then we'll go back to many more examples. So here's how it works. When you sell a covered call, you're giving someone the right, but not the obligation to buy your shares at the price that you set. In exchange for that, you collect a premium, cash, that you pocket immediately. The beauty of this is, no matter what happens, you keep that premium. So if the stock stays below that price that you set, the strike price, you just keep your shares and you can sell another covered call the next month, collecting another premium. It's like getting paid to wait for your stock to go up. This is the best strategy for having high quality companies that you love in your portfolio and making them work for you, making these companies spit out cash flow via selling covered call options. The key here is selling covered calls on stocks that you don't mind owning long term, that you really enjoy having in your portfolio, and then just making them work a little bit harder. Okay, so this way, no matter what happens, you're in control and you can generate a steady stream of income each and every single month. This strategy scales very well, whether you have a small account or you're managing millions like those NBA players I mentioned earlier. That financial advisor went to my college and I've learned a lot from him. I've also taught myself a lot from working at Goldman Sachs and just experimenting with covered calls, picking the best deltas. I made a lot of mistakes, guys. So in this video, you have a blessing, something that I didn't have, which is a mentor, someone that has gone through the tough times, the good times, and everything else in between, that's going to show you everything that you need to know step by step in 5 easy steps on covered calls and generating $8,000 a month. In fact, it's one of the safest option strategies out there because you're never risking more than the stocks that you already own. And that's why it's perfect for beginners to generate safe passive monthly income. And I'm going to show you later in this video that even if it goes into the money, there's a lot that you can do, like rolling that option higher. So here's what we're going to cover in this free course. Step number 1, own 100 shares of a stock. Step number 2, pick a strike price. Step number 3, choose an expiration date. Step number 4, sell the call and collect your premium. Step 5, wait for expiration or manage the position. Let's get started and go into step number 1, owning 100 shares of stock. This is the foundation of selling covered calls because, well, you need 100 shares to sell a covered call. Now, this 100 shares, you want to be very confident in the stock. And I always recommend in a lot of my videos to own between 10 to 15 stocks in your portfolio because owning 10 to 15 stocks in your portfolio means that you are diversified without being over diversified. Because if you have too many stocks, you might as well just have ETFs. So let's break down the logic and the best practices behind owning 100 shares of stock, which is the very first step to running a covered call strategy. Each option contract covers 100 shares of a stock. So in order to cover your covered call, because it has to be covered, If you just sell a call option, you have a lot of risk. In fact, unlimited risk. You never want to be in that situation. You always want to be covered. So to be covered and have your call be a covered call, you need to own 100 shares of a stock. If you sell a call without owning the shares, it is very risky, and it's called a naked call, where you're obligated to buy the stock potentially at much higher prices. Again, not recommending that. Our first step is owning 100 shares, and that gives you exposure into a stock that you like. Now, here's the best practices, okay? This is really important. The first one is you want to pick a good, stable company, a quality stock. Start with large, well-known established companies, often referred to as blue chip stocks. This can be Apple, which I showed you an example of in the beginning of the video. It can be Microsoft, it can be Coca-Cola, it can be Johnson & Johnson, it can even be a growth stock like Nvidia. As long as you don't have more than 10% of your money, this is just a general rule and a general standard, then you should be okay if the company has larger than a $5 billion market cap. These companies tend to have very stable growth. They sometimes pay dividends. Even Nvidia has a small dividend, but they don't have to pay a dividend. All that you're looking for is a company that is profitable. It has a PE ratio. Companies that are not profitable don't have PE ratios because they don't have any earnings at all. You want to pick a company that has a price earnings ratio, and the lower that price earnings ratio, typically the better. However, be careful because not all stocks are the same and not all PE ratios are the same. So sometimes you look at a stock like Nvidia. Here you can see on the screen that Nvidia has a high PE ratio. It doesn't mean that Nvidia is a bad stock. It just means that it has a lot of growth. Investors expect a lot of growth, and therefore a higher PE ratio is justified. You do not want to run the strategy on highly volatile or speculative stocks that could tank or basically be very unpredictable. That's because if you want safe, steady, passive income of $8,000 a month very consistently without having to experience the highs and lows, the highs are fun, but the lows are definitely not fun. If you want to actually retire just on this strategy, which I think is very possible, especially if you have a portfolio that you scale to 6 figures and beyond, then you want to focus on blue chip stocks. You want to focus, again, on companies that are S&P 500. Okay, and ideally the top 100 stocks. So Tesla's a good example. Also, stocks like ExxonMobil, okay, oil and gas companies, they can also be viable picks in your portfolio. You don't want to run this strategy on highly volatile stocks that have poor brands, poor cash flow, lots of debt. Okay, you don't want to run that strategy on these type of stocks. You want to run them on just the highest quality stocks. Number 2, okay, we went over the first step for owning 100 shares, but I want to continue on getting the 100 shares because this is the most important thing. The stock selection is the most important thing. You pick a good stock, you'll make money in the strategy. You pick a bad stock, the strategy won't save you. All right. So number 2, you want to have a long-term investment mindset on the 100 shares that you buy. Make sure that the stock is one that you'd be happy holding for the long term, even if you can't sell calls on it for a while. Let's say the stock drops a lot in value. You can't always sell covered calls. If a stock, and we have a stock market crash, which I'm not in control of, guys, we can't control that or predict the future. If the stock market falls a lot, you will still want to be comfortable owning the stock because you have a long-term investment mindset on the stock itself. So if the stock market drops, the stock drops, you won't be able to sell covered calls for some time because it would probably be better to wait for a recovery. If the stock market pulls back 10% or more in 30 to 90 days, then in almost all cases, because we do get really big and fast rebounds, I would not be selling covered calls because as you'll learn later on in this course, that if you sell covered calls, you have a risk of losing your shares. And if you potentially lose your shares that are under your average cost, although a lot of that is psychological, it's still not really the best practice in many ways. It's debatable. Okay. So if your shares get called away or sold when the buyer exercises the call option, you want to feel confident that you're selling the stock at a price that you're happy with. Okay, so it's really good to have a long-term mindset on the stocks. That way, you don't panic. Your 100 shares you're going to be holding and selling covered calls on a regular basis. But if we experience a market crash or a pullback, which can happen at any time, all right, it happens when you least expect it. And I think we are in, we could be in store for a pullback in the near future. You want to be prepared for that, regardless of the market condition. So you always want to be in a high-quality company that has good cash flow, good PE ratio, revenue is ideally growing. You do not want to be in a company where revenue is not growing. Okay, just simply go to a, like Yahoo Finance or something like that and look at the income statement. If it's growing, that's all you need. So here's an example of Nvidia's revenue. And as you can see, it is growing very fast. So that's a very positive sign. And that's why the price to earnings ratio is higher. Now, number 3, I want to talk about diversifying your stock holdings, because again, as I said, getting into high quality stocks and buying 100 shares is step number 1. So step number 3 in step number 1, if that makes sense, right? In number 1 of buying shares, you want to diversify the stocks that you're holding. While selling covered calls on one stock is fine, it's better to diversify across several sectors or industries. This way, you aren't really overly exposed into one company's performance. If you own multiple stocks, you can sell covered calls on different ones at the same time, maximizing your income potential while spreading out your risk. I have several students of mine who I do work one-on-one with. I do Zoom calls and I give them my trades and I look at their portfolios with them hands-on. I have several students that are in the IT space and they work for the biggest companies, FAANG companies, Meta, Amazon, Netflix, Google, etc. Right? And I look at their portfolios and oftentimes see that they're running covered calls, but they're doing it only on tech stocks. Please don't make that mistake. If you work in a certain industry, you actually want less exposure into that industry because your life is already dependent on that industry. You're already working in the industry. If you work at Amazon, it does not make sense for you to buy a lot of Amazon stock and to be in similar companies. Like, it just doesn't really make sense. Okay. So make sure that you keep this in mind when you choose your 10 to 15 stocks. Make sure that you're picking different industries. That's really important for generating $8,000 a month with the covered call strategy safely and consistently. Is part of that safe component is you need diversity. You can't just be invested in one stock. Now, I will make an argument that for me, Apple is a really big position that I'm running covered calls on, and I have 50% of my money in Apple in my main portfolio. Out of my 2 portfolios, my main portfolio, which I've been tracking on YouTube transparently and authentically with every single trade I've made, I showed all the time, my wins, my losses, I have tough times, I have good times, but we've gotten my portfolio from low 6 figures to multiple 7 figures, which is beautiful, and the proof's in the pudding that this is a very good strategy to use. So be aware of that. Now, number 4 within buying 100 shares of stock, all right, is know the stock's volatility. All right. More volatile stocks can provide higher premiums, but they also increase your chances of losing that stock and the chances that the stock price might exceed your strike price, leading to your shares being sold. If you're comfortable with that, it's fine. But for beginners, it's often better to start with less volatile stocks, okay? It's less fun because something like NVIDIA has a lot of volatility. So it's fantastic to have NVIDIA in your portfolio. And I would say it's very useful, as well as Palantir, 2 stocks that I cover on this channel quite often. I've been in for a number of years and I've made money hand over fist, bicep over tricep. We made so much money on it, but it's still important to watch out for volatility. Less volatile stocks, you can still collect consistent cash flow and premiums without worrying too much about your shares being called away. Let me show you a quick example. Let me show you guys an example of different covered calls that I would have, and I'll show you my portfolio actually, so you can get a sense of where my portfolio is at. If you're watching this video in the future, to be honest with you, my portfolio doesn't really change that much. I'm always paying attention to the same stocks. I get to know them on a very deep level, and I just sell covered calls on basically all of these stocks that you'll see right now. So I'll go over position by position. You can take this with a grain of salt because I'm not a financial advisor. I'm just the guy that's made multiple millions of dollars trading options. But again, take this with a grain of salt. Use this on the stocks that you personally believe in more, or feel free to kind of mimic and take ideas from me. All right. I organize my portfolio from biggest position to smallest position. So right now, my biggest position is Apple. I am selling covered calls on Apple. If I show you my positions on Apple, and I'll go step by step right now into each position, and then we'll go into the rest of this course. I just want to show you examples so you understand. We're talking about stock selection, guys. Stock selection is very important. And I'll tell you why I hold some of these stocks. First of all, Apple. Apple is iconic brand, right? I have an Apple iPhone. I'm in Poland and this is also an Apple iPhone. Everyone has Apple iPhones, right? I've been across the whole world. Apple is one of the best companies. Because Apple is a good company, they keep having follow-up products. They have a great brand. One thing that I like about Apple, actually, price to earnings is reasonable. Dividend is reasonable. It's one of the biggest companies, but it still has good volatility. The options are still have good volatility. So I'm selling 230 covered calls. I'm selling puts as well. I'm just doing covered calls all around, and selling covered calls is really profitable. Like, as I showed you in the beginning, I mean, you can make $7,200 just on Apple alone doing covered calls, okay? So biggest position for me is Apple. Now, the second biggest position, and this is controversial because a lot of people think that you can't make a lot of money on boring companies, but that's just not true. It's just not true. It's a complete myth. I made a lot of money on Walmart. So if I go into Walmart, and I'll show you how to protect your gains, by the way, because I have a lot of covered calls on my stocks and I do not want to lose my stocks because I'm up a lot of money on them. I'm up $175,000 on Walmart, and I'm selling, currently I have 81 covered call. Now, Walmart is actually a little bit above 81, so this option is a little bit in the money. I will be having to roll this option. I'll teach you in this course later on towards the end, because rolling is the more advanced topic. It's really how to manage this position, which is at the very end of understanding this whole strategy. All right. So Walmart, I'm slightly in the money, but I'm not worried at all. I have not had a problem with covered calls for 7 years. All right. I've been trading for 10. My first 3 were a little bit rough. Then my last 7 have been extremely profitable. I've done very well, enough to not have to work a day in my life again. So I make these videos not because I have to. I make these videos because I want to. I enjoy it a lot. Love helping people a lot. I love working with folks, and that's why I became a one-on-one coach recently. I got tired of just working with too many people. I did get burned out. Even though I love this, I now prefer to do one-on-one coaching calls and just helping folks like that. So Walmart is fantastic. PayPal has been very lucrative as well. PayPal, Palantir obviously has contributed a lot to my growth on this channel and to this portfolio. A lot of these gains in the portfolio are from Palantir as well as Tesla. All right. So I'm just looking at the same stocks, and for me, low volatility Apple, very low volatility Walmart. PayPal is medium volatility. Palantir is higher on the volatility, but it still is an option trader's paradise. It's just a paradise. Absolutely. Target, similar reasoning to Walmart. I made a lot of money. Let me just go into Target. I made a lot of money on the options themselves specifically. Obviously, my options have expired over and over. When a covered call expires, by the way, just open up a new covered call. That's all you have to do. So I've had options expire over and over and over for Target over a long period of time. I'm up $21,000 on the stock, which isn't too much. Good gains for sure, 25% returns, but I made absolute killing on the options themselves. You know what? I can go through my history real quick, just for transparency purposes. And I also want you guys to understand, I'm going to go to my history and we can just take a look. It's been a long history of Target. So you can see here, I have some dividends. I have some covered calls I've sold, more dividends, covered call rolls. We'll talk about covered call rolls in a bit. I've been in this for a while. October 25th, 2023, which was forever ago. It's like over a year ago, or it will be at some point when you're watching this video. It will be well over a year. I was selling 109 puts. Beautiful. I've done very well on Target. So, and I'll also show you my watch list, because you may have different ideas for what you want to buy. So let me just go through this. I respect your time. Let me just go through this. I just want to give you everything. I want to give you everything in this course so you understand on a deep level. Covered calls. So you got it all. So you got it all and you understand everything. Amazon, obviously Amazon speaks for itself. American Airlines, guys, this is a top tier, S tier stock that I think is fantastic. Just absolutely fantastic. If I go into American Airlines, this is the pattern that you want to look for when you're looking for a stock for covered calls. You don't have to pick the best stock that's going to go up. You have to pick a stock that's not going to go down. That's something that I bet no one talks about. You don't have to pick a good stock that only goes up. You just have to pick a stock that doesn't go down. It's not powerful. You can make a lot of money in cash flow, $8,000 a month for sure on good quality companies that don't even have to go up. The company can just stay the same and you make money. How awesome is that? It's literally awesome. Option trading gives you that safe passive income without a lot of risk, and you don't even need the stock market to really move. Just love it. Just love it. So look at this. Over the past 5 years, besides it being right here, American Airlines has really not done a lot. It just goes up, goes down, goes up, goes down, goes up, goes down, goes up, goes down. Over the 1 year return, it's negative, but if you're selling puts and covered calls, you're going to be acquiring shares at like $10. And right here, you would have acquired shares at $9. So you can see here, my average cost is $10.91. I have recently gotten out of the stock, not because I don't like it, but because I've made a lot of money on the wheel strategy and my covered calls. The wheel strategy is selling puts to get in and then covered calls to get out. My covered calls ended up selling off my shares at a gain. So I did lose shares, and now I'm back in the stock and I'm looking to acquire more shares and keep selling covered calls. This is literally a stock that I've been covering since 2020. Been at this game for a long time, and I've coached many students. Now I've coached a large quantity of students, and now I'm focusing on more the higher, more hands-on approach, more old school approach of working with folks that want to get to retirement, that want to retire and focus on retirement income. And I think that covered calls is that perfect retirement strategy. This is my higher risk play, very small amount, like less than 1% of my money. Google, very good since it pulled back. Chipotle is a top pick for me, and Adobe. I have several one-on-one students that work at Adobe, and I like what they're doing. Okay. I like what the stock is doing a lot. So other stocks that you can own, and feel free to create your own list. As I already mentioned, the most important factors in picking a stock. You can look at Disney. You can look at NVIDIA for sure. Microsoft is fantastic. Meta is, see, I wouldn't have Meta right now in my portfolio. The reason is because when I look at year to date, it's about to be 20 to 25, but the 64% return that it had in 2024 is just a little too much. The stock's at an all-time high and you don't want to do covered calls when a stock is at an all-time high. You want to look for a stock that is well away from its all-time high, unless it's in a really big bull run, but I don't know if Meta is going to continue the bull run. Nvidia, yes, Meta, I have some doubts about, but regardless, this course is all about using the covered call strategy, and you can use it on the stocks that you believe are really good. Again, you don't have to listen to my opinions. I'm just some guy with opinions, right, on the internet. Chipotle is very good. Kraft Heinz is fantastic, guys. So look, if you're trying to generate $8,000 or $10,000 a month, you still need some dividend paying stocks, because when you sell covered calls on dividend paying stocks, you kind of amplify and get a bigger dividend. You essentially get dividends from the stock, and then you also get upside because the covered call gives you upside, and you get the covered call premium. How can it get any better than that, right? Fantastic. Used to work at IBM. I've had a lot of jobs in the past, guys. I've had many internships. I've worked on Wall Street multiple times. I've actually worked in tax accounting. I worked at IBM. I have it on my watch list. It's a high dividend paying stock. They're not really growing a whole lot, but I also have a lot of one-on-one students from IBM. Again, I mainly work with medical professionals and engineers. That seems to be a majority of my students, right? But also any 9-to-5ers, a lot of 9-to-5ers that want that safe passive income so they can leave their jobs, right? I really enjoy traveling the world and having freedom. Time freedom, financial freedom, location freedom. I love freedom. Feels amazing. I don't need to be a billionaire. I don't even need that much money. You can live a fantastic life just selling covered calls. It's really good. So I follow IBM. Now, Starbucks has been a very good moneymaker, very good one. I'll show you in the bonus material at the end of this course more about Starbucks and different strategies, like the poor man's covered call. But in general, selling covered calls for income on Starbucks, I think, is pretty good, especially it's under $100. New CEO, there's a lot of good stuff coming for Starbucks. Now, I would not do covered calls on, Hims, for example, or Sweet Greens. So these are more volatile companies, and these would be more for advanced traders. Now, maybe intermediate traders as well. I wouldn't do that. I wouldn't do it on any China stocks. I would just literally do it on blue chip companies. Okay. So Nike's down a lot today. Now check this out. The market's not open just yet, but when the market opens up, I'm going to be doing a covered call on Nike. You want to look for a stock that has pulled back. When a stock has pulled back and you do a covered call, you get a better entry price. You get a better entry price. You don't want to buy it at all-time high. Looks like Nike went up a lot and now it's pulling back down. This is a very interesting pattern. Nike was a $122 stock. Now we're at 82. So I would say that this is a great time to sell a covered call. So just for an example, and we'll talk about strike selection in just a moment, but typically I like to pick strikes that are just slightly out of the money at a 30 delta. So if I were to go for an expiration date like in October, or, let me just go for something like closer to 2025, like January, I usually go for like a 30 delta. So if I expand this option right here, this is still a high delta actually. Wow, it's very high. If I go for the 130 delta right there, this right here would be a really good return, $282, and you get a lot of upside. So this is how you can make $8,000 a month is on Nike. If Nike goes to $90 per share the next, 3 months or so, you essentially get $800 plus you still get to keep the premium of almost $300. You make over $1,000 on just one contract on Nike on a safe play. And that's how the covered calls can really stack up in your favor. So look, I want to cover the last thing about buying shares, and then we're going to move on to step number 2. I think I've made my point here on how to pick stocks and select them. So look, it's important to understand dividend impact. Some stocks pay dividends, which can be a great way to earn extra income in addition to selling covered calls. However, you'll want to keep track of the stock's ex-dividend date. If a call option buyer knows the dividend is going to be paying out and it's coming, they actually might exercise the option early to capture that dividend, meaning that you could lose your shares before the payout. By following these best practices, you'll make sure that the stock that you're selling covered calls on fits your overall financial goals while minimizing unnecessary risks. The last thing that you want is a stock that you're up a lot of money on, and if the option is in the money and its ex-dividend date, there is a heightened chance of getting exercised, which is why it would be better to close out the covered call. However, it's always good to remember that the primary reason for owning 100 shares is to control the 100 shares. And once you're in the money, you don't really control as many shares. I'm going to explain that in just a moment. It's always good when the option is out of the money on a covered call. You're turning your stock holding into an active income generating asset while managing your risk. Okay. Once the option goes into the money, it's not really providing you as much income anymore. What that means is when a stock goes beyond your strike price on a covered call, it's usually smart to start thinking about closing that position. We'll talk about that in managing your risk. Now, finally, let's Go into step 2. We understand owning 100 shares, all right? You sell a call option on your 100 shares, okay? We understand the 100 shares part, but now let's talk about selling the call option part. Once you own 100 shares of stock, the next step is selling a call option. That means that you're selling someone else the right, but not the obligation to buy your shares at a set price called the strike price within a specific time period called the expiration date. In exchange, you collect a premium, which is your income from the transaction. Let's dive into the logic and best practices for this step. Here is the logic of selling a call option. When you sell a call option, you are agreeing to sell your stock at a certain price if the buyer chooses to exercise the option. The buyer will not choose to exercise the option as long as it's below the strike price. If it's above the strike price, that doesn't mean that the option buyer will automatically exercise. There's many different conditions, okay? The premium that you receive is your compensation for taking on this obligation. If the stock doesn't reach the strike price by the expiration date, the option expires worthless. And that's a good thing. You get to keep both your shares and the premium. If the stock does hit the strike price, your shares may be sold, but you still need to keep in mind that the premium is yours regardless. And you also sell the stock at the higher price that you have bought the stock for. So let me explain. If you bought a stock for $100 and you sell a covered call at 110, worst that happens is you sell it at 110. It's not going to be sold off less than 110. And at 110, it also doesn't mean that it's going to be exercised right away. It's only going to be exercised basically at the last day towards expiration, okay? Or maybe the last couple of days. What does that depend on? It really depends on the volatility. It also depends on the delta. Typically, if the delta is very high and the options vary in the money, I'm going to tell you right now and later in this course, it's definitely better to close out a position, a short call option, to not lose your shares if the delta is above 70. Okay, if it's above 70, you definitely want to close, or closing is very simple, or roll, which we'll cover later. So here's the best practices for selling a call option. So now we're in step number 2, and we're going to talk about step number 1 and step number 2. All right, so step number 1 is you want to choose a strike price that fits your goal. If you don't want to sell your shares, set a higher strike price above what you think the stock will reach by expiration, okay? The stock will likely stay below the strike price so you can keep your shares and still pocket the premium. So let's say that we're gonna take a look at Nike. We were talking about Nike. We see that Nike is at $82 per share. When I sold a $100 covered call, as an example, I don't think Nike's going to go to 100. So that's why I'm selling the 100 covered call, is because I think that it'll stay below 100. And that's why I would use this covered call option right here on the screen. If you're okay with selling your shares, pick a strike price closer to the current market price. The option is more likely to get exercised, meaning your shares may be sold, but you're also going to collect a higher income. The reason why you collect a higher income when the option is closer to the current price is because there's a bigger chance of it going into the money. And because there's a bigger chance, you get paid because there's a bigger chance, because you're taking on more risk. And because you're taking on more risk, you get paid more premium. Now, number 2 within step number 2 is selecting an expiration date wisely. A short-term or a weekly or monthly expiration date is preferred. Okay, so selling options with closer expiration dates allows you to collect premiums more frequently, but those premiums are typically going to be smaller. But that's okay because you can collect them on a more frequent basis. Now, a long-term or a long-term expiration, so selling longer-term options called leaps typically, provides larger premiums up front right away, but you'll be tied up in the contract for a longer period of time, reducing your flexibility. There's absolutely nothing wrong with that. I have many students who are busy engineers, doctors, lawyers, medical professionals, and they don't want to look at their portfolio all the time. And actually, research shows that investors that look at their portfolio less often outperform. So there's actually was a research study that showed that teachers, preschool teachers, kindergarten teachers, they had bigger returns than financial professionals working on Wall Street because they made less decisions. So I think there's absolutely nothing wrong at all to sell covered calls that are 30 days out, 90 days out, even 6 months out. As a beginner, shorter expirations, 30 days or less, are a good place to start because they give you basically faster learning. You get to see how to open, how to close, and how a position works out. But as you gain more experience and as you have a bigger portfolio and as you get into retirement, it's very easy to just sell options that are 30 to 90 days out for regular income. That's where I make a lot more than $10,000 a month in income, but that's where a lot of my students are making their desired incomes, for their retirement needs within a reasonable amount. I have students that have a few $100,000 portfolios and they're easily generating a 5-figure amount with six-figure portfolios. So as a beginner, I will say that it is actually good to go for shorter expiration dates because you have faster learning, not necessarily because shorter term options are better than longer term options. Okay. Now, the next thing I want to talk about is understanding moneyness. I mentioned already out of the money, in the money. Okay. And out of the money option is a strike price that is higher than the current stock price. Okay. Looking back at Nike, if you look at the current price of 82 or, thereabouts, anything above 83, 84, 85, 90, 100, that would be considered an outs of the money option. Now, I want to go over an at the money option and show you guys some examples. I'm going to show you an at the money option and an in the money option. Okay, let's start with actually in the money, because if I go to my total return, if I go to a stock where I have a covered call, like we can actually choose Walmart. Walmart is currently at $81.12. My covered call is at $81. So this would actually be an in the money option because Walmart is above my covered call. So I'm up a lot on Walmart, $175,000, but I'm slightly down on the option itself. So it's going to be important for me to manage this position once the market opens up. Not even necessarily today. This is actually not that big of a deal because it's very slightly in the money. And as I just mentioned, it's only important if it's a 70 delta. And if I go into this option, it's only a 55 delta. So it's not yet really that much of a risk, but I will still want to transition and kind of roll this option and adjust it, just make a slight adjustment. So this would be an in the money option and a not at risk in the money option. Okay. I don't have any high risk in the money options right now, but hypothetically, if I had, let's just go to Adobe real quick. I think I'm doing good on Adobe 535. So I'm doing good on the option. I'm down on the stock, but let's say that the stock shoots up to $600 per share. Okay. And I have a 535 call. That would be a deep in the money option. And that would probably be a 70 delta or higher. So I would really want to close out this option. Otherwise, I would risk the chance of losing the shares, which I wouldn't really mind. I would not mind losing it because take a notice here. My average cost is $534 per share and my Adobe covered call is at $535. So the Adobe covered call is higher than my average cost. So, and I collected premium. I wouldn't mind at all. Now, there's another term called at the money option. And at the money option is basically a strike price that is very close to the current stock price. So the current stock price of Adobe is 504. And if I were to sell a covered call at 505, this is technically out of the money, but we can also call it at the money. So essentially that's the difference between out of the money, at the money, and in the money. You always want to start off almost 99% of the time by selling out of the money options. This gives you upside. This also gets you income and it gives you very low risk. Now, I want to talk about balancing premium versus risk. Higher premiums often come with greater risk, like having your shares called away from you. If you want consistent income while holding onto your stock, opt for slightly out of the money options. Like I said, out of the money options are going to give you that upside and give you like lower risk of losing the shares, which offers a good balance between premium size and the likelihood of keeping your shares. Very important point. Consider implied volatility or IV. Stocks with higher implied volatility, the expected movement of the stock offer larger premiums because there's a greater chance of large price swings. However, this also increases the chances that your stock price will hit the strike price, leading to your shares being sold. For beginners, it's better to avoid highly volatile stocks and stick to more stable ones, as this will provide safer, more predictable premiums. Monitor your stock and options regularly. Once you've sold a call option, keep an eye for the stock's price movement. You don't have to do this every day, but if it goes into the money, that's when you have to pay attention. If the stock price approaches your strike price, you'll need to decide for yourself. Do you feel comfortable? Do you think that the stock will continue in that direction? Because if so, it might actually be wise to close before it goes into the money. Remember, if a stock goes into the money with your covered call, it's actually not that much of an issue if you're happy to sell the stock at that price anyways. It's only really an issue when you have a really big gain and you don't want to pay taxes In that case, you just want to close out the covered call and sell a new covered call. And I'll show you the process for that later on. Now, this is also very important because selling a covered call, this is the bread and butter right here. Don't sell a call right before major events, okay? Avoid selling covered calls before earnings reports, dividend payouts, or other significant news events that could cause the stock price to spike or for the stock price to drop. Because if it's going to spike, you are going to underperform, okay? I love options. I made millions of dollars trading options. I teach options, but even myself, I will tell you, it's not worth selling options. If a stock spikes and it goes up by 20%, it's not smart to have a covered call. You better just ride the stock. Now, if it drops, you probably ideally want to avoid that event. Obviously, the stock market is not predictable. Yeah, having covered calls actually before a drop is it can be very smart because you're giving yourself a margin of safety. So for example, let me show you, let's take a look at when Adobe has earnings. We'll just take a look at Adobe as an example. So if I scroll down here, so let's say that we're going to sell a covered call that captures earnings. Could be okay, and I'll tell you when it can be okay. So if I go for December 20, which would capture it in the earnings, let's say that your strategy is more for income. You don't really care too much about upside. You can go right here at 505, which would be an at the money option. You can collect $3,000 on this covered call. And if it goes down, I mean, you couldn't predict that. Obviously, you shouldn't be in the stock if you think it's going to go down. But let's say you're 50-50, you don't know. This covered call would provide you a good source of cushion, $3,000 worth of cushion. You can think about it as subtracting $30 off of the price. So essentially, you're buying the stock for $474 per share. So you get a good cushion. So I actually kind of like covered calls before earnings because the volatility is higher. Therefore, your income is also higher. By following these best practices, you maximize your chance of generating consistent income while keeping your risk manageable. The goal is to strike a balance between premium income and the likelihood of selling your shares, giving you control over the stock's portfolio while earning steady passive income. So I hope this course is giving you a lot of value. If it is, I hope that you subscribe and use this course to actually make consistent income and get to 5 figures plus per month in income. So after you have sold a covered call, the next step is managing your position. This means monitoring how your stock and the option are performing and decide whether to hold on to the position, let it expire, or roll the option to extend your profit potential. Let's dive into the logic behind this and the best practices for managing your covered call position. Here's the logic of managing your covered call position. Once you sell a covered call, your goal is to either keep the premium while retaining your shares or to sell the shares at the strike price for a profit. However, things don't always go according to plan, which is why managing your position is very crucial. If the stock price approaches the strike price or moves unpredictably, you need to make an informed decision to protect your capital or increase your income. The main decision you'll face is whether to roll your option. This means buying back the option you sold and selling another one with a new expiration date and/or a new strike price. Rolling allows you to adjust your strategy without closing out your stock position. Here's the best practices for managing your covered call position. First, you want to monitor the stock's price regularly. If the stock price is approaching the strike price, you need to assess whether you're comfortable selling the stock at the price or if you'd prefer to keep the shares and roll the option to a higher strike price or a later date. Keep an eye on the news or events that might cause a significant price move, such as earnings reports or economic data releases. Although I personally don't do that myself because I think that a lot of this stuff is priced in or not really foreseeable, I think it can be very helpful for understanding your covered call risk, which is also very important in and of itself. Set a profit target for the option premium. If the value of the call option has decreased significantly, say 50% or more of the premium you originally collected, you can buy back the option early to lock in a profit and close the position and just take your profits at that point. This reduces your risk of the stock price hitting the strike price and it gives you the flexibility to sell another covered call. Now, avoid holding onto the option until expiration if you've already collected most of the profits. This can be tough to determine, but let's say that you've sold a covered call that's out 6 weeks. And on the 3rd week, halfway in, you've already made a profit of 90%. In my opinion, it doesn't really make sense to hold a covered call for 3 more weeks, which is half half of the total time for 10% of the profits. So closing out early can kind of minimize your risk of unexpected price movements upward, but also taking a large profit early, giving yourself basically the opportunity to sell another covered call for more money, is a really smart move. Next, you want to roll the option if necessary. If the stock price is close to or above the strike price and you don't want to sell your shares, you can roll the option by buying back the original contract and selling a new one for a higher strike price or a further expiration date. Now, rolling gives you the flexibility to keep the stock, collect more premiums, and adjust your strategy based on the current market conditions. This is especially useful when the stock price is rising steadily, but you still want to maintain your position. You don't want to lose your position yet. You can roll and adjust the strike price. Let me show you an example of what that looks like in my portfolio. So what you can do is say that I have a covered call on Walmart. So the market's about to open up and here's the exact trade that I'm going to make. It's a very simple trade. So Walmart, I have a 81 covered call and the stock is at 81.16. So this is literally the perfect timing for me to roll this option higher. So on Robinhood, it doesn't matter what brokerage you use. They're all just vehicles that do the same thing. Not an expert there. You can roll this option from 81, right? In just one click, I just clicked roll option. I can roll from my current 81 position, and this expires on October 11, which is like really, really short term. And I can roll it out for 1 month further, okay? So I can go from October to November. If you're watching this in the future, just copy and paste this logic and do this for yourself. Whatever month it is, roll out by about 30 days or so. So I can go from 81 and I can roll this higher to something like 82.5. And this is an absolutely amazing roll. This is like money right here. So look, I can move from 81 on a covered call to the 82.5 covered call. Okay, I'm moving out by about 30 days. I'm actually going to get paid $4,740 by rolling this position out and up. Okay, let me explain to you what that means. If I roll it out, that means I'm going from October to November or any month to another month. So I'm rolling out by 1 month and I'm rolling up from 81 because currently Walmart's at 81.16. So it's just a little bit in the money. I can roll this option up from 81 to 82.5, giving myself an extra 1.5% of upside. That is remarkable. If this wasn't reason enough that you can make a lot of money trading covered calls for safe, passive, consistent income, I don't know what is. This is literally the #1 strategy. And even when it goes into the money, here's the best way to fix it. You just move up. You go from 81 here to 82.5. So this completely fixes my position. It actually makes me $4,740 and I'm only having to wait 1 month. That's exactly what time has to do with option trading. This time that I'm adding to this option completely changes the profit of the option by a lot. Okay, so I want you to pay attention to time decay or theta because as the option goes to expiration, as the expiration date gets closer, the value of the option will decrease due to time decay, which is a good thing because when you're selling options, you want them to decrease in value. You want to sell them expensive and buy them back cheap. This option works in your favor as a seller since the option's value erodes over time. In the last week before expiration, time decay accelerates, which is a great opportunity to capture profits, and a lot of people like to sell shorter term options. So if we actually look at my portfolio, I do have a covered call on Apple for very short-term expiration, which is actually completely okay. It's currently showing me as a loss. Don't be shocked or worried if your covered call is a loss, unless it's in the money. Apple right now, I have a 230 covered call, but it's at 225. It's currently out of the money. My option is showing a current loss. Now, why would that be? The reason why is because Apple has gone up and I have made money on the stock itself, but the option is more likely to be at 230. And because of that higher likelihood, the option has become more expensive. It has gained value. And because as an option seller, when an option gains value, it's actually a bad thing for you because you want to sell expensive, right? But this became more expensive. So essentially it has gone against us slightly, but I'm not worried at all. It's still out of the money. absolutely nothing to worry about. And actually, this option has extremely high theta, very high theta. Each contract here is going to lose about $37 a day. And I have 57 contracts. So if I do the math, it's like $2,000 or so. It's like $2,000 a day, which makes a lot of sense because this option is going to expire in a couple of days, worth about $4,400 out of the money. And 2 days from now, I'm going to make $4,000, which is about $2,000 a day. So I hope this is really starting to make sense to you, that selling options, covered calls for income is a fantastic way to retire, generate income that's safe. And this is exactly how options works. You sell them, you give it time, they expire out of the money, and you do it all over again. If they go in the money, you roll like I just showed you. Here on Apple, I'm excited. I think this is going to work out very well. So I always pay attention to time decay. And I know this option is safe. I just know it because we're out of the money. It's at 225, it's at 230. If it goes to 230, I'm going to do exactly as I just showed you on Walmart. I'm going to do exactly that. So I'm going to roll it higher. I'm going to roll it out in terms of expiration date and up in terms of expiration strike price. In the last week before expiration, time decay really accelerates. You can see how I'm making $2,000 a day on Apple. So it's no surprise that you can get $8,000 a month with a smaller portfolio. You don't need to have seven-figure portfolio to make this kind of money. You just need to have multiple different positions and count the time decay and scale up and grow your portfolio. And this works in your favor because as a seller of the option, the value that decays every day is the value that you make. So in the last week before expiration, time decay really accelerates, which is a great opportunity to capture profits if the stock price remains below the strike price. Now, the next thing that you want to be very aware of with this strategy is decide what to do if the stock is near or above the strike price. If the stock is trading close to or above the strike price as expiration approaches, you have several options. I've showed you several of them, but let me go over them in detail. First of all, you can let it expire and sell your shares. If you're happy with the strike price and profit you'd make from selling the stock, you can let the option expire in the money and just, you'll sell your shares. You'll be assigned. You'll lose the shares, and that's fine. You'll lose them at a higher price. You'll make money. Number two is you can buy back the call option and keep your shares. If you don't want to sell the shares, you can buy back the call option, usually for a loss, but this allows you to retain the stock, okay? So it's not a problem to buy back at a loss. I can buy back this covered call right now for $1,000 loss, but I'm up like hundreds of thousands of dollars on Apple, so it's really not a big deal. Now, the next thing is you can roll the option, which is probably the preferred strategy for me. If you're in a rising market and you still want to keep the shares, rolling the option to a higher strike price allows you to potentially collect another premium and keep profiting from the stock's appreciation. So I always pretty much 99% of the time prefer just to roll, okay? I roll all my options. So I showed you an example on Walmart. On Apple, I would just roll from 230 to 235. Here's actually a 235 covered call on Apple that I'm up $100 on. Here's a covered call on Adobe. I'm up $535 on Adobe. Some of my one-on-one students that I work with, I do Zoom calls, I give them trades, they have unlimited texting with me. A lot of them work at big tech companies. So Adobe is one of them, and I really like Adobe a lot. So the total return here is 1657 on covered calls on Adobe, and I'm bullish on it. I want to acquire more shares, but it is very expensive. Even for me, Adobe is quite an expensive stock to do 100 shares of, which is why later on in this video I'll show you how to basically improve that situation and not be in that situation of having to put up so much capital. Other stocks I would basically go for right now, one of my top picks is going to be Chipotle. And on Chipotle, I see if I have a covered call going on right now. I believe I do. So I have shares at $55 per share, and I have just more. I've sold some puts because I want more stock. As I mentioned, if you're really bullish on a stock, you don't actually want to sell covered calls. You want to wait for the stock to appreciate in value and then sell covered calls when you think it won't appreciate too much more, which is why I don't currently have any covered calls on Chipotle. But to be honest with you, I could easily, and I may sell some. If I go to sell call and I go to an expiration date that's in January, I can easily go ahead and sell a $60 covered call here. And I have 1,000 shares. So if I go for 10 contracts would be 1,000 shares, $3,000. $3,000. You can see how collecting premiums really adds up. And this would be opening up a new position, but rolling is essentially closing a position and opening up a new one. Now, something that I would never do is I would avoid chasing a stock. If the stock is moving quickly upward, don't panic and don't roll too aggressively into a higher strike price. Selling too far out of the money can reduce the premium that you collect and limit your income potential. Keep a very measured approach and stick to the plan. Okay. Evaluate the opportunity cost. Don't just go ahead and roll options too aggressively. If the stock price has risen significantly above the strike price and you've already made a good return, it might be worth letting the stock just getting called away and realizing the gain. You can then reinvest the profits into another stock where you can repeat the covered call strategy. Always weigh whether keeping the stock is worth more than taking the profit and moving on to another opportunity. So paying attention to opportunity cost is very important, and reassessing your position after expiration. So oftentimes these options will expire out of the money. Like Chipotle, I have made money on covered calls. I don't have any covered calls right now and I have shares, and I'm reassessing my position after I've had expiration. And I'm thinking to myself, should I open up a new position or not? Once the option expires, either worthless or in the money, reassessing the stock, a strong long-term investment. If it is, and you think it's going to rise a lot in the short term, then don't sell a covered call. But if you don't know, which is most of the time, we don't know. As investors, we cannot predict the future. No amount of news or research can really help you predict the future. No good investor knows, not even the billionaires. So that's why I prefer to always be selling covered calls. I am always selling covered calls, guys. I really believe in it. I have all my money in covered calls, and I'm also doing other strategies in my portfolio, of course, videos that I cover on this channel. In fact, if you want a video on selling puts, I made a course on selling puts. I don't know if it's out just yet, but if it's out, check out in the description. It's a full course on selling puts for income, very similar to this video. So you want to reassess for yourself. Does it make sense to sell a covered call? And most of the time, I think yes. As soon as my position expires on Friday, right? The expiration happens 4 p.m. on Friday, and in the morning or whatever, Saturday, the options typically settle. Monday morning, when the options market opens up and the stock market opens up, you have an opportunity for yourself to say, hey, do I want to sell another covered call? And for me, I almost immediately sell another covered call to keep generating monthly income. I did mention I'm a one-on-one coach, but in all my one-on-one coaching, Discord and group coaching is included in the one-on-one coaching. So I have Monday calls, and that's where I'm basically selling put options and covered calls and all the other strategies I use. And every Monday when I have shares that are uncovered, I'm typically selling covered calls because I want to make income. I depend on the income, by the way. I do have a high income. I have multiple businesses, and I've been very successful, and God has blessed me with the knowledge and the ability to learn quickly and to make good things happen in my life. So I'm very thankful and blessed and grateful. But I try to basically spend around what my income is from the options market, which is pretty high. So I can't really spend it. I do donate my mom's animals and stuff like that. I just want to say that you want to grow your portfolio steadily, and the money that you generate, it's either you can reinvest it or spend the money. The income that is made and generated is meant to either retire and spend or to continue to reinvest and grow your wealth. So I do a lot of both of those things. I either reinvest or I find something to use the money for, and either for my personal reasons or for lifestyle, whatever. So if you pay attention to the covered calls that you're doing, you should have again 10 to 15 covered calls that are generating income. And if each position can generate $1,000 a month or even every 2 months, right? 10 to 15 stocks is $10 to $15,000 every 1 to 2 months, something around that range, right? So also pay attention if the stock's fundamentals have changed. I said that I open up covered calls every Monday morning, but I pay attention to covered calls if the fundamentals have changed. I see some stocks in the portfolio that can pull back a significant amount. If it has changed, I will aggressively sell covered calls. Now, let me actually quickly look at my total return for my positions. I have mainly good positions. Kind of embarrassed to say this, but I made a mistake on Snapchat. All right. So it's a very small position. Luckily, I don't make big mistakes. I'm very good at what I do. Been at this game for 10 years and very good at what I do, but I'm not perfect. I'm only human. I put a small amount of money into Snapchat, and it went down a lot. So I will be selling covered calls. Actually, the market opens up very shortly. So I'm going to show you an example of selling a covered call. As the market opens up here in a couple minutes, I want to give you some more tips on managing your wealth. And then I'm going to make a trade here, which is going to be below my average cost. Now, I'll be honest with you. This is very interesting because it has to do a lot with psychology. But in this present moment, I'm okay selling a covered call below my average cost, right? Below my average cost of $14.29. I'm okay with that because at this point in the moment, I want to make money. My average cost is actually something that's old and it's psychological. It doesn't really matter if I sell my shares above $14.29 or not. The only thing that matters is if I get good results every single month in consistent income. Right? So if this meets my consistent income needs, then it's okay to go below the average cost. because average cost is something in the past. It's a sunk cost. Okay, a sunk cost from economics. Give you this quick story while the market opens up. A sunk cost is very important to be aware of because your average cost doesn't truly matter as much as you think it matters. If you bought a train ticket and you're going to New York City, you lost a train ticket, you're gonna have to buy another train ticket, right? That train ticket that you lost is called a sunk cost. Okay. Same thing with the average cost. I really view it as a sunk cost, although it's interesting for me to look at because from an ego level, right? We all have egos and we all have like psychological emotions, right? That drive us both in our personal lives and our financial lives. It's important to be aware of this because a lot of my students, even the smartest ones, the doctors, the lawyers, business owners, my typical student who has over $50,000 to invest, they still fall for this trap where they're not selling covered calls for income because the stock is below their average cost. I don't personally believe that. So let's actually go into the trade because we have, what is it, like less than 60 seconds before the market opens up. So let me open this up right away. By the way, first thing in the morning, options are more volatile, but if you're selling options, that's not necessarily a problem. I have average cost of 14.29. I have 3,700 shares. I'm going to go to trade snap options. I'm going to sell call. Now I said that I don't mind going out a little bit further in terms of date. I'm retired myself. I enjoy what I do, so I continue to work, but by choice. So, but I do prefer monthly options. So I'm going to go for a November 1st expiration day here. November 1st, okay, I'm going to go ahead and just sell a covered call. The premium here is very high. This is very good. So look, you might think to yourself, am I scared to sell at 11.5? Yes and no. So from one perspective, I don't really want to sell Snap at 11.5, but from another perspective, this is $1 away. I would make $1 per share, and then I would also collect $49 of income. So I'm going to go ahead and do this on all 37 of my shares. Wow, the bid-ask spread is awful. This is a very bad bid-ask spread. Very bad. Now, this is not good. I cannot sell the November 1st. This $49.99 is really bad. So I'm going to go for, and that's also because it's an 11.5 strike. It's not as popular. So I'm going to go for a January 17, 2025 covered call. So here the bid ask is 78 and 113. That's better. And here it's 113, 146. Not bad. This is a really high income. I'm not going to sell all 37 of my contracts. I'm just going to go for 17, which is basically like a $2,000 return. And I'm going to go for 1.2. I'm trying to be quick with this video and not waste time. So I'm going to go for 1.2. But just so you understand, I could go for 1.25 and likely get filled for more. But for the purposes of this video, I want to make it quick. So I just kind of lost myself $5 times 17, which is like $85. So hope you leave me a like and a subscribe for that. But it would have been smarter if I would have went for like a higher limit price, but doesn't matter. I just collected some income, about $2,040. On Snap by doing a covered call. So yeah, it's very good to sell covered calls for income, and the average cost doesn't always really matter. So if the stock's fundamentals have changed or it no longer fits your strategy, consider selling it and moving on to another stock. I'm not married to any one stock. I am just trying to get monthly consistent results for myself and for my students, because that's all that really matters. We care about risk, money, return, and time here. So manage and assess your risk. This is very important. If the stock goes above the strike price, you might get a sign early, meaning your shares will be sold. And that's important to pay attention to. But if the stock has pulled back a lot, you may still want to sell covered calls that are going to be out of the money. While rare, this can happen, particularly if the stock pays a dividend or there's an event, or dividends don't really affect the stock that much, but you get what I mean. Things happen in the market and you want to be prepared to understand all scenarios and when it makes sense to sell covered calls. I've showed you multiple scenarios. I'm going to show you another one, but I first want to say that it's also very important in this stage of selling the covered call to stay disciplined. Covered call writing, selling covered calls, is a steady long-term income strategy. Avoid the temptation to chase big returns by taking unnecessary risk. Stick to high-quality stocks and manage your trades in a way that prioritizes steady income and capital preservation. By following these best practices, you'll be able to manage your covered call position effectively, adjust when necessary, and maximize your income while protecting your capital. How awesome is that? Just everything that you could hope for in making money, trading, controlling risk, whether you're dealing with a rising stock, a falling stock, or a sideways market. Disciplined management ensures long-term success with covered calls. Now, with that being said, let's go over several covered calls in my portfolio, and I want to review them and teach you from real practices, okay? So because the market's open, we're going to have a fun time and put some of this money to work. And yeah, let's make it happen. Alrighty, so we're in my live trading portion I want to go to my account real quick. I want to go to investing and let's see how much cash I have. So $245,000. Okay. I don't know how many trades I'm going to make. My videos are typically unplanned. Let's see what kind of opportunities I can spot. First of all, I want to look at my watch list and just look for a stock that I like. Chipotle is a stock that I like. So we're likely going to do Chipotle. I'm up very little bit of money on it. I don't know why it says pre-market, but the stock market's open. So I'm gonna go for shares. I'm gonna buy 100 shares here. I'm gonna review and buy. So I just bought 100 shares. There we go. So I just purchased 100 shares and I currently don't have any covered calls. As I kind of mentioned, I think Chipotle will rise, but I'm not against selling some 60 covered calls on it. I will go for a November 15 expiration. Again, if you're watching this in the future, just copy the logic and the teachings here. Yeah, hope that this is really helpful for you. That's really my mission. And yeah, that's really what I want to do. I just want to help create passive income and steady income for everyone. So 60 covered call, very good because it gives me good upside. And I just bought it for obviously like $56. So if it sells for 60, I'm totally fine with that. I have 11 contracts, so I'm going to go for all 11 and this will be a good return. I'm going to go for 1.7, although I can go for 1.75, but I want to get filled for sure and not waste any time in this video. So I'm going to leave some money on the table, like $55 I left on the table there. Play around with the bid-ask spread. You should go somewhere in between. So I just went for the bid, which basically guarantees me a quick fill, right? But could have went for 175. Anyways, I collected $1,869 there on all my shares of Chipotle. So just being honest, like that wasn't from the one contract, it was from 11. One contract would have made me $170, would have made me 170. That is good. That was a good trade there. We can track how much income I made on the bottom. Pretty good. Go and see what I can do with another stock. By the way, just being honest with you, the premium collect isn't realized just yet. It has to go to expiration, obviously. Starbucks is a good stock. I don't have any in my portfolio. It's been a while since I've traded this stock, so I'm going to go ahead and buy 100 shares of this stock. Just showing you how this works. So review the order. So first you buy the stock. So there you go. I bought 100 shares and now I'm going to go to trade Starbucks options and just go to sell call. I can go short term. I can go medium term. I do like 30 to 90 days. So let's just go for 30 days. And oh my goodness, I'm turning 30 basically at this date. Halloween, November 1st, I'll be 30. Oh, 30 days, I'll be 30. Well, I take care of myself, keep making money, and keep teaching, doing what I love. Can't control that, right? Can't control it as you age, but yeah. So sell the 97 covered call. I'm going very close to the money, guys, because I don't know if Starbucks is a great bargain right now at this price level. It's definitely not bad, but by going close to the money, I get good income and I get a decent margin of safety. So I'm happy with this. This is a 50 delta. There's no volume today, but there's open interest of 159. The bid ask is kind of bad though. No, I don't like the bid ask here. That's because I'm going for a weird expiration. The third Friday is the best expiration. It's the typical standard expiration. So third Friday is going to be better. I'm going to go for the third Friday and you know what? I can go for the 95 covered call. So this is going to be interesting. I said that going out of the money is good, but if you want that really steady, safe, passive income, then you can go for an in the money option. There's nothing wrong with in the money options. Why this would be good is if Starbucks pulls back, it's not really that much of an issue for me. I'm still pretty good because look, if it's above 95, I'm going to sell it off. I don't mind. My break even is 100 here. I'm guaranteeing myself 100 exit point. But if it goes down, it's fine. I'm going to be better off than a stock investor because a stock investor would lose money. Here, I also lose money if it goes below 95 minus what I collect 5. So my break even here on the top end is 100. So I guarantee myself 100 exit point and I guarantee myself an entry point of around $89.85. Amazing. That's because at 95 is basically where I would have to sell it and I'm collecting 500. I'm not really liking the bid and ask spread too much and I'm not going to put 515 for the bid ask spread because I'll show you an example. I can probably easily go for 5.4. See, it says medium fill likelihood, medium. All right, so I can go for 5.35. Let's see if I get filled here. So let me go ahead and submit this right now. So I've submitted the trade and I got filled for 540, basically 539.97. So add that to the premium collected. These are not big positions and these add up. If you have 10 of these positions, this would be $5,000 a month. That's not really, I'm not investing crazy amounts of money on this one. So there we go. Let me see what else I can buy right here. So we have 2 trades. We've made over something on the bottom here, some good income. Alrighty, let's take a look at what other positions I can do. Palantir, guys, we made a lot of money, but I'm sorry, you've kind of missed the boat. Not very expensive, but it's getting more expensive. I haven't traded Square for a very long time, so Square could be something that I might look at. Let's take a look at the 1-year return. We do have pretty good support here. We can see how there's a huge bounce at $57, and now it's at 65. I do follow this stock. I know Cash App is pretty strong, so I will do a sell put. I'm going to go very safe here. I'm not going to go for nothing crazy. I'm going to go for November 15. Oh, darn. I'm used to selling puts up right away. I'm used to selling puts right away. Usually I run the wheel strategy, but it's the same thing. Covered call right off the gate is also good. Let's go ahead. I'm going to do shares. Okay, I'm going to do 100 shares here. I'm not trading crazy amounts of money, and you can definitely get to 5 figures a month if you have 6 figures. But even if you have less, I mean, this is a great way to scale your portfolio. I have a 65 average cost. So I'm going to go to sell call. I'm going to go for just yeah, I'm going to go for the November traditional expiration, the 3rd Friday. All right. And then I'm just going to go for 65 right at the money, collect $5 of income. Big money. Big money. The bid ask here is phenomenal. 5.25, 5.35. That's a beautiful bid ask spread. Again, I can go 530, but I'm not trying to waste time on this video. So there we go. I got filled. Good stuff. So we're going to add to the screen. We made another $525. Beautiful, beautiful. All right. So I showed you a little bit of a mix of like my old strategies. Oh, by the way, look at that. Look at that. Guys, the market opened up. Look at that. Theta. Oh, Theta kicked it. Oh, Theta just kicked this options butt. Look at that. I was just showing you guys like, what, 10 minutes ago, 15 minutes ago, how I was down 1,300 on this position. But today, Theta is coming in like a, I don't even know, like a professional athlete, just smacking this option on the face. This option just completely exploding in value, decaying like it's going to the graveyard. That's some quick money. I was showing you earlier in this video, this option was negative 4,400. Now we're at negative $2,000. So I made $2,400 in one day on this option. So things are looking good. And guess what? It's because the option isn't going to 230. So on a covered call, when the option doesn't go to the strike price, time kills the option. It kills it. And when you're selling options, that's a good thing, right? I sold this option 21 hours ago. So I guess I did on my live call. I did this very recently. So goodness, this is only one day. I'm already up $1,400. So a little bit of volatility, but hey, this is looking beautiful. This is exactly how you want to trade. Okay. So that's up. All right. So I've showed you guys some ways to on old positions, on new positions. Now I still want to open up another option trade here. Let me see. I got to do one more option trade. We got to do one more. Got to do one more. Hood is a little bit expensive. I'm a bit afraid of that one. You know what? I know what I'm going to do. American Airlines. AAL. AAL is a good one. It's a very good one. All right, this stock just goes sideways. I like it a lot. So I'm going to do AAL. I do have no covered calls on it. I'm going to go ahead and buy, let's see how much, 400 shares would be $4,000. Not much, to be honest. Let me do 900 shares. Yeah, it's less than $10,000. So bada bing, bada boom. We're going to buy 900 shares. And there you go. My average cost is 1064, 1,000 shares. And now I'm going to do a trade covered call on American Airlines. We're going to do something for, I can go shorter term as well. Nothing wrong with that. Do 11 covered call and make that short term income. So I got 11, how much contract? I got 10 contracts. So 10 contracts, 0.35. Boom. So we just sold it and we got filled. Let's go. We got filled 10 contracts. We're going to add $358 here. Obviously, if I start selling covered calls on Apple, I can make tens of thousands of dollars. So yeah, if you want help hands-on trading like this, and so I can show you my plays and help you rearrange your portfolio, get into some profitable covered call positions, I'd be more than happy to help you. You can visit the first link in the description. Hope this course was very helpful for you. And I'm looking forward to making more content to help you scale up and generate consistent passive income. And I'll catch you guys in the next video. And I'm going to leave a video here on the screen that if you want to get better at option trading, keep watching. This is the best skill that you can learn how to make online income safe and passively with good risk management. This is another video that I definitely want you to watch, and looking forward to helping you out some more.